Thank you for inviting me to participate in this conference. So as Dahlia said, some people have additional affiliations. I'll point out that I'm an advisor to UBIX, and that the information that I'm going to present today draws from my own work and aspects of the UBIX white paper, and some joint work that I did related to central bank digital currencies with Haozheng Zhu and Jiaheng Yu. So I'm going to talk, the title is Beyond the Stablecoin Oligopoly. And so essentially what I'm going to try and do today is give some idea about where stablecoin markets are headed. And actually I'm going to agree with Christian. I'm going to be very, very consistent with some of the stuff that he said in the final minutes of his talk, but maybe fill in what I would say are some of the details that are necessary in order to have an outcome that does not involve a stablecoin oligopoly. So let me start off with sort of a confession. So back in 2022 with former colleagues of the New York Fed, I wrote a paper entitled "The Future of Payments is Not Stablecoins." And at the time, stablecoins had just gone from basically nothing to something. So values around $160 billion in just a couple of years, and today, of course, that's even much higher. So around 226 billion, with some estimates saying that the stablecoin market cap will reach 1 trillion in the near future. I've even seen estimates of 2 trillion. So of course, while that's been happening, there's been changes in regulation, and so this is a major thing that's occurred since the last election, really, in the United States, which is the introduction of this executive order, the Strengthening American Leadership in Digital Financial Technology, and of course the proposed Genius Act and Stable Act, and I think we're going to hear more about that. And my understanding is the passage of the Genius Act is imminent, so we'll be looking forward to that. And what does that mean? It means that commercial banks and financial institutions are very likely to be entering the stablecoin market. What does that mean? Well, we're in a world where conventional wisdom would suggest that stablecoins are going to follow the same digital platform economics of things like Google and Meta and Amazon, where there becomes a single or a few dominant participants. And there are standard arguments for this. There are arguments that relate to size, liquidity begets liquidity, the idea of established exchange relationships. So major exchanges accept a few of the primary coins, but not all of the smaller coins. The idea that issuers can set up distribution modes. Christian mentioned the idea of brand recognition. And then there's also regulatory advantages, because as regulations on stablecoins increase, only the ones that have the capacity to deal with those regulations can function. So lots of reasons why we might expect the stablecoin market to continue as an oligopoly. And in fact, that's what we see today with USDT and USDC dominating the market with over an 85% market share. And that's despite the fact that on some dimensions, newer coins have come in that offer in some ways more secure backing. You could argue that PayPal USD offers in some ways the most direct form of backing, in the sense that the assets are put in trust accounts as opposed to just a straight claim on the issuer. But as I just mentioned, all these other reasons seem to indicate that we will continue to have this market that's dominated by just a couple of participants. But what if we rethink these arguments, and the fact that these arguments really rely on thinking about stablecoins as private media of exchange? And if we think about that, then some of the factors that allow stablecoins to dominate in the market today are likely to be eroded, and that's really what the new regulations that are coming through are likely to do. And in particular, the situation becomes very different if established commercial banks and other established financial institutions are allowed to issue stablecoins. So it's already the case that banks would be able to deal with some of these issues that are associated with the idea of creating stablecoin oligopolies. So in particular, brand recognition and compliance, large banks certainly have those things already taken care of. And it's also the case that if we think about the ideas that are related to size and distribution that the current incumbent stablecoins have been able to create, those might disappear if stablecoins were processed through a common infrastructure, and I'm going to talk about that. So key to this new thinking on stablecoins is a new perspective in terms of thinking about what stablecoins really are. And so first of all, as I was just suggesting, stablecoins are not competing private monies in the sense of Hayek. So I think much of this idea of thinking about stablecoins as competing monies could be related to this idea of Friedrich Hayek's book on the denationalization of money, where he talked about the idea that, well, why do we need sovereign currency? We could have private currencies that compete, and these currencies would be disciplined by market competition, and that type of monetary system would be fine. There's a sense in which the stablecoin markets look a little bit like that, but stablecoins aren't actually like that. Stablecoins aren't outside money. I mean, this is what Hayek was talking about. In the context of Hayek, each of these monies would be its own unit of account, and they weren't backed by anything. Stablecoins are just a representative of the US dollar. In fact, the best way to interpret stablecoins is to think of them as checks. Okay? I mean, what is it that we do when we make a payment in a digital world? In a digital world, we have an international liability structure, right? We have proprietary data sets around the world, and we make a payment. We don't actually move money. We don't actually hand some kind of physical object from one person to another. What we need to do when we make a payment is we update balance sheets. And there's a variety of ways that balance sheets can be updated. Balance sheets can be updated through the conventional deposit transfer process, but balance sheets conventionally have also been updated through the use of checks. Right? So you can go to your bank and you can obtain a paper check, and you can use this paper check and you can give that to someone. And when you do that, that creates an instruction that leads to an updating of balance sheets. It leads to a reduction in the amount that your bank owes you and an increase in the amount that the recipient's bank owes them. So what's the difference between stablecoins and checks? Well, conventional checks are drawn on your account and they're made out to a particular recipient. But if we can think of something like a cashier's check, what's a cashier's check? A cashier's check is drawn on the account of the bank. It's not drawn on an individual account. That's very much like it's a claim on the issuer. Now, cashier's checks are typically made out to individuals, but then we could actually go a little bit further and we could draw the analogy to traveler's checks. So what is a traveler's check? A traveler's check is something where you give money to purchase the traveler's check. You give it to an issuer. You then have this bearer instrument, this paper bearer instrument that can be given to anyone, and the recipient can hold this bearer instrument, and it is something that ultimately could be used to update these conventional balance sheets. So what are stablecoins? I'm arguing that stablecoins are clearing instruments. They are ultimately instruments that can be used to update the balance sheets that represent the liability structure in the economy. They're not outside money, and really the only primary difference between stablecoins and a check is the rails that's used for transfer. So instead of putting a check in the mail and sending it to someone, or physically taking the check and handing it to them, I transfer the information via a public blockchain system. Okay. Now, one of the key things, of course, with stablecoins is that they do function as bearer instruments. That is, that they can be held, and when they're received, they don't have to be redeemed. But I think a key aspect is that people do have the option to redeem them. They have the option to redeem them at par value from the issuer, but there are some impediments. And so if we look at this chart is just showing you some of the major stable coins, so Tether, USDC, and DAI, and it's just showing you what some of those impediments are. So typically when you try to redeem a stablecoin, it's not as easy as I would argue it should be. So sometimes there are limits on how much you can redeem, so you can't redeem small quantities. It can sometimes take time. Sometimes not everyone can redeem. Sometimes only the people, primary holders, can redeem the stable coins. And so there's a number of problems. This is also associated. Also, there can be costs. So there are a number of problems associated with redeeming stable coins. I think it's interesting to draw a historical parallel. So if we think about post-Civil War and the experience with checks, checks were issued by private banks, and it was often very difficult to redeem or to cash checks. Checks would have to go from one participant to another. They'd have to travel. There'd be costs associated with that travel. That travel would be embedded into the redemption cost. Sometimes the costs were significantly large. The banks would have to find several stops along the way before they could actually be redeemed. This resulted in significant delays, and the cost of redeeming checks varied depending on the issuer. This was resolved largely when the Federal Reserve Act of 1913 mandated that regional Federal Reserve banks would redeem all checks from member banks at par. So this was essentially centralized clearing of checks. And what was key about this is that given this essentially a guarantee, the issuer attributes became less important as the clearing process was standardized. So all of a sudden, it didn't really matter so much who the issuer was of the check, so long as that issuer was a bank in good standing with an account at its regional Federal Reserve Bank. Checks became very successful, and in fact, checks became in some sense a victim of their own success because checks became so burdensome that, of course, we developed alternative ways to pay, which was the development of what is today the modern ACH, which is a form of essentially making direct deposit transfers. And now that accounts for $30 billion in payments, or sorry, 30 billion payments annually worth approximately $80 trillion. So I think one of the things that's sort of interesting to highlight there is that when we think about the stablecoin market, as big as it is, it's still just a drop in the bucket of the overall payments market. And so when we think about what the future is for stablecoins, we're really thinking about what fraction of this market we ultimately capture.
Can I ask a question?
Sure.
So are these still personal checks like we know them today, where they're drawing on individual deposit accounts, or where they're drawing on the bank?
What are you?
So these checks that were circulating around, what were they?
What I'm talking about, it originally was just a history of personal checks.
It is personal checks.
Yes.
So how does the Federal Reserve system know that an individual has sufficient balance to cover it?
Well, they still have to go through a clearing process to make sure that that's true. But that clearing process ensures that if everything is okay, that those checks are redeemed at par. So I think it's very natural to ask then, well, what if stablecoins were cleared like checks? We could have a clearing system for checks. And in such a world, just as I said, as happened with conventional checks, the emphasis moves from the issuer to the instrument. Just as we don't differentiate between JP Morgan checks and Bank of America checks, stablecoins could have similar uniformity if there was a proper market structure in place. Okay. With a clearing system, recipients could deposit any stablecoin at any bank for full value. And this would create a level playing field, which would, as I said, shift the emphasis from the issuer of the check to the use of the check itself. What are some of the potential benefits of this? Well, one of the key benefits is the singleness of money. And as you may know, I've written a number of papers on the singleness of money. And what is the singleness of money? Really, the singleness of money is just a property of payments. And what the singleness of money really means is that when a payment is made, the receiver doesn't care who the bank is of the issuer, of the person that's making the payment, of the payer. Right? You don't care, because you're not going to receive a dollar from that issuer, you're going to receive a dollar in your own account, and you know for sure you're going to receive a dollar because that's what the rules of the system say. Now, stable coins are a little different because unlike a conventional deposit transfer, we don't eliminate the IOU from the issuer and create a new IOU at the recipient's bank. The recipient can actually hold on to the IOU of the issuer. So how do we guarantee singleness? We guarantee singleness if the recipient has a guaranteed option of redeeming at par value. So they don't have to exercise that option, but they have to have the guaranteed option. If they have the guaranteed option, then they'll accept that stable coin at par. If you think about what would typically happen, think about a person that's at a bank. So I have an account at a bank, or better, think about a situation where a person has an account at even a small regional bank, Richmond Bank of Staten Island, my mother-in-law. And suppose I wanted to send a payment to my mother-in-law, a stablecoin payment to my mother-in-law. How might I do that in this world? In this world, I would send a stablecoin. I would have a stablecoin in a wallet. I'm thinking about a world where these wallets would be hosted by financial institutions, so I'm KYC'd, these are regulated, okay? I have this stablecoin, and I would send this stablecoin to the account of the recipient, okay? Two things could happen. One possibility is that that bank provides stablecoin wallets for its customers. If that was the case, then the recipient would receive the stablecoin, and they could hold the stablecoin, excuse me, or they could choose to have that stablecoin redeemed, in which case that stablecoin would be sent to the clearing system. The clearing system would redeem the stablecoin, and deposits would appear in the account of the recipient at par value. Again, those are the rules of the system. It's also possible that the recipient would be at a bank that doesn't provide stablecoin wallets. Well, then what could happen is when I want to make the stablecoin payment, my bank sends the stablecoin payment to the clearing system, and the clearing system could just initiate a conventional deposit transfer from the issuer's account to the recipient, say through FedNow. Right? Either way, the stablecoin payment can be made. Whether or not the stablecoin is redeemed or not is optional, but the fact that there is the guarantee of redemption at par value through the clearing system is what ensures the singleness of money. Okay? The recipient doesn't care who the issuer is of the payment that they're receiving. Okay. Another key aspect is that once you have this singleness, and once you have this immediate ability to convert a stablecoin into a conventional deposit or cash, then stablecoins can have cash equivalent treatment from an accounting perspective. And that opens up lots of possibilities. It would allow stablecoins to meet liquidity requirements. It would allow stablecoins to meet cash equivalent balances for public disclosures. And it would allow stablecoins to be used in many ways, both on the payment side and in terms of holding value to meet regulatory requirements. Another interesting thing that would happen in this world where stablecoins are cleared is that we would likely see lower stablecoin market caps. So stablecoins wouldn't always have to be held. So we wouldn't have to get these massive balances of stablecoins. Again, in a world where stablecoins act as checks, they wouldn't probably often be held by the recipients in that form. If you think about businesses making payments this way, they would probably aggregate lots of stablecoin payments, but they would like those payments to be converted to deposits in their accounts. And so the life of a stablecoin might be very short in this world. The stablecoin would be issued for the purposes of making the payment. The stablecoin would go through the clearing system, or maybe a bunch of stablecoins would go through the clearing system in a batch transaction. Those would all be redeemed, and the value would end up in the recipient's account. So the life of the stablecoin there would be very short. And so this is important from both a regulatory and systemic risk perspective. From a regulatory perspective, it could probably allow a lighter regulatory treatment. So I think the Stablecoin Act suggests that there be only state level regulation on stablecoins with market caps under $10 billion. And then because stablecoin values are, outstanding values are lower, there's less systemic risk problems that occur from possible stablecoin runs or other problems that might occur. Another potential benefit, and this is more of a wish list that I have, is the idea of safe fractional backing. So once we have stablecoins issued by banks and a system where stablecoins go through a clearing system, I see no reason why these stablecoins that are issued by banks would have to be backed by 100% highly liquid assets. Just as deposits are backed by the strength of the private commercial bank balance sheet, I would think that the coins issued by commercial banks could also be done this way. And if this were to happen, then this would satisfy the main objections that we actually raised in that original Liberty Street economics post that I mentioned at the beginning of this talk. So at that point, whether you would call them deposit tokens or stable coins, I don't know, but the idea is that you could create these bearer instrument tokens that were issued by private banks against their balance sheets that could function as a very efficient way of providing the clearing services that stablecoins currently do. I want to finish by just talking about some of the interesting, I think, financial market effects that would result in a world where we had widespread issuance of stablecoins by the traditional financial sector, and the existence of a clearing system that ensures singleness. Pointing out that this would be a scenario where stablecoins exist alongside other existing payment infrastructures. And the point I wanted to bring up is this idea of improved competition among banks for depositors. So one of the things that I think would be true in this future world is that stablecoins combined with a clearing system would be something that could be provided in some ways equally by all financial institutions. And what the economics suggest is that this would result in an increase in average deposit rates and improved monetary policy transmission. And let me give you some of the explanation for that. So this is the world that I'm envisioning. So we have a current world where we have large banks and we have small banks. And large banks offer, in many instances, improved payment services over small banks. So individuals have value for these payment services. We call that convenience value. And so individuals can have different convenience values, denote that by some parameter delta. And we can just say that the convenience value of a small bank payment services is 0. That's just a normalization. The way I'm thinking about something like the existence of payment stablecoins combined with a clearing system, and I'm suggesting something like UBIX, is that this would create sort of a base level of convenience that's common to all financial institutions that provide these stablecoin wallets, because they all go through the same clearing system. They're all equally good. They're just checks, as I've described. Well, what this does is it changes the way that banks compete. So banks are currently competing on 2 dimensions. They compete on interest rate and they compete on convenience value. But what the introduction of a clearing system does is it puts a lower bound on the convenience that's offered by large banks, and it raises the value of convenience of small banks from 0 to some level. We just call that V. And as you can see from this equation here, right now small banks to compete, they have to provide a higher interest rate than on deposits than large banks. But if we have this common clearing aspect, convenience aspect that comes from clearing of stablecoins, then the gap that they have to provide shrinks. So it means that small banks can offer lower deposit rates, and still attract customers. I'm not presenting the full model in this short talk, but this is just shows you what the model would predict in this environment. So I'm showing you two panels here. We'll start with the panel on the right. So the panel on the right looks at what the convenience value is. And you can think of the units of that convenient value as like percentage points, okay, sort of analogous to the interest payment. And as you raise that convenience value, so how much percentage points on interest would you give up for convenience? You can think of it that way. As you raise that convenience value, what the model suggests is that the market share of the small banks rises and the market share of the large banks shrinks. So we get a reduction in market concentration, which could be perceived as a good thing. On the left panel, we're looking at what happens to interest rates. What happens to interest rates is quite interesting. So again, as I said, as we introduce this idea of a common value convenience, as that convenience value increases, small banks are able to compete for deposits more effectively through the convenience channel without offering higher interest. And so the amount of interest that the small deposit interest that the small banks have to pay shrinks. That's the red line coming down. This is a scenario that applies, by the way, at relatively low levels of interest rates. So at these relatively low levels of interest rates, large banks are constrained. They basically provide an interest rate near zero. But as the convenience value rises, eventually these large banks start to raise their interest rates, and eventually we get an increase in the overall rate of deposits, rate of interest that's paid to depositors in terms of the weighted average. So two market effects. One is we get a reduction in concentration of depositors in the banking system, and the other is that we can, for sufficiently high levels of convenience so that the system provides sufficiently high levels of payment convenience, we get an increase in the rate that's provided to depositors. So that's for any given level of the federal funds rate, the rate that depositors get is higher. And in fact, one can also show that under certain conditions, that as you increase the federal funds rate, deposit rates increase at a faster rate. So we get more pass-through. By the way, we can think of analogies where things like this have happened before. So that is systems where we've added something to the conventional banking system, a new type of infrastructure that is in some ways common to all participants. We had Swish, for example, in Sweden, and we've actually seen an increase in deposit rates in Sweden since Swish was introduced. What I'm showing you in this little text box on the right here is a study that was done related to PIX in Brazil. And so the launching of this essentially mobile payment app in Brazil has resulted in exactly the effects that we see in this diagram. So that is a reduction in the spread between deposit rates offered by small banks and large banks, and an increase in market share of small banks relative to large banks. So let me just conclude. What I'm trying to argue is that first and foremost, we have to think of stablecoins, in at least the stablecoins that would be issued by in the traditional sector, as clearing instruments. And that a clearing system that would ensure that these stablecoins can be redeemed at par would be highly complementary to existing financial market infrastructures. It would, in some ways, to use what Christian said, make stablecoins boring, but that's what they need to be in order to be widely used. There are other issues that still need to be addressed. AML, CFT issues, but those are being dealt with. There's also privacy issues, but there are certain networks that certainly deal with this, the Canton network, for example. And what I'm talking about here, by the way, is the future that we would foresee for stablecoins in terms of the use of stablecoins as they arise from the traditional financial sector. So it's the connection between the financial sector and public blockchains. It's in that environment. I think it would still be the case that for stablecoins that exist entirely within decentralized systems, there would still be dominant players. There's no reason why Tether still wouldn't capture the markets. that Christian described. But what I think would be very beneficial to financial system, to payment systems more specifically, is the use of these stable coins as I said, a complement to existing financial infrastructures to improve the speed, efficiency, and safety of payments. So, thank you.
I think we're very privileged to have one speak to us. I do want to point out that this was a great demonstration of the gap between technologists and economists, in that we can get you to scroll through slides with a single click. We'll have to teach you how to do that later.
No, the click doesn't work. The click doesn't work. The click doesn't work.
Questions?
I'll break the ice.
I tried.
If there's one thing, Rod, that you'd love for regulators to get right, and maybe it's not going to happen in the Genius Bill or shortly thereafter, what would it be?
Well, so I think the current regulation is very positive, and so, but what I think everything I've said can work if the current regulation passes. So the main thing is to allow banks and other institutions from the traditional sector to be able to utilize this massive resource, which is public blockchains. As I said, that alone doesn't get us all the way there. I think we need the creation of these other infrastructures, which are very familiar to the traditional financial sector, but that ensure these properties such as singleness that are so essential. Again, you can think about getting approximate singleness, and in fact, a lot of the regulatory discussion is about the backing assets and making sure that the backing assets are sufficient that we get very, very close to singleness. But what I'm arguing is that that's, approximate singleness is not singleness. That, even if it's the minute it's approximate, you care who the issuer is. And to have fully efficient payment system, you need to not care who the issuer is. And for that, you need perfect singleness. And you can obtain that through an infrastructure. Singleness isn't so much a market outcome as it is a combination of market outcome and institutional rules. And that's what I think we can create in the stablecoin market. So in terms of the existing regulation, as I indicated, what doesn't make sense to me entirely is that a traditional financial bank that currently issues deposit liabilities on a fractional reserve basis, if it wanted to tokenize those liabilities and allow them to transfer through these systems, then it would have to do so on you would have to essentially create a narrow bank or subsidiary in order to do that. So I would hope that at some point that banks would be allowed to issue stable coins, or maybe call them deposit tokens if you want, that would be backed on the strength of their balance sheet, not that they don't have to create these subsidiaries. Sure.
A comment and a question. One, I would push you a little bit on the singleness of money today. Commercial bank deposits are not fungible except for Fed backing and clearing systems, and I do care who the issuer is, even as a regular user, to the extent I have deposits above the government insurance, right?
Yeah, well, okay.
And then second, we have Fed now, sort of. And I was wondering if you saw the same, at least the beginning of the same trend that you saw with PICs, because you think you'd see the same sort of trends in the US if Fed now is, maybe it's just not working enough yet.
Yeah, no, I think with the Fed now, it's very different, right? So the environment in PICs is, people were using cash. I mean, it's just that transforms that landscape. In the case of Fed now, the issue is that everybody would like to receive payments immediately, but the banks don't necessarily have an incentive to process these payments quickly. So I think comparing Fed now and PICs is sort of apples to oranges. And sorry, your first point was.
I don't think our money is all that single today.
Oh yeah. Sorry. So this I think is what the misconception is. So the term singleness of money is not very well defined, but it's a property of payments So saying that the singleness of money property does not mean that you're indifferent between having a deposit at Bank of America and having a deposit at Richmond Bank of Staten Island. That's not what singleness means. Singleness of money is a property of payments. It means that when you make a payment, if that payment goes through, it goes through at par.
Yeah.
So it's so that's I think that's
Got
the key
it.
point.
Okay, that's
Yeah.
helpful.
So at one point you talked about the regulatory environment for lower market cap stablecoins as a result of those stablecoins having a shorter life because users might want to just directly convert the stablecoins getting transferred back into fiat.
Yeah.
In your example, you mentioned transferring money to your grandma across the country, and that's one example. I think another aspect of transferring stablecoins is on a much larger scale, and correct me if I'm wrong, but you would want stablecoins with deeper market caps and deeper liquidity to handle larger transactions. So do you think there's a role of lower market cap stablecoins, or my thinking is that it'll just stay consolidated?
Yeah, no, good question, but I think it depends on what you mean by lower market cap. So I think the regulation is talking about 10 billion as a cap. So I'm not necessarily, I just use that example to sort of just illustrate different ways that a stablecoin payment could occur. You know, I'm not necessarily talking about $100 payments. I mean, you know, we would expect look, the vast majority of payments that are made in the economy are business payments, or business to business payments, vast majority. And so we would, of course, want these stablecoins to be utilized for making, various corporate payments. And so these would be payments that are in the millions or even billions of dollars. But my point is that instead of this sort of the activity all generating this massive stock in stablecoins, which tie up billions of dollars of liquidity because they have to be 100% backed, at least today. The stablecoins are just, as I said, in this world, they're utilized by the banks as clearing instruments. So the stablecoin's created, it moves through the system, it gets redeemed. And so we just wouldn't have, in my opinion, this massive stock of stablecoins. So it's still allowing very, very large payments. I'm not just thinking about small $100, payments. But in a world with a clearing system, again, which is optional. The stablecoins do not have to be cleared. It's just that the clearing system exists, which is important because in a lot of cases, people want the ability to have to receive the payment in the form of conventional deposits. But also, as I said, that's absolutely crucial, is that the right to redeem, the guaranteed right to redeem, is what ensures the true singleness. Yeah. So, but no, I'm not precluding very large payments, and I am thinking that the main applications would be say corporate payments. I just used an example involving an individual. Yeah. Sure.
Does the fact that there's very liquid markets between different stablecoins, does that not imply that they're sort of single already? You can very easily swap USDC for USDT.
Well, you can't very easily. But no. Look, I mean, there's plenty of people that have given presentations on how stablecoins lose their pegs all the time, and sometimes they lose them in relatively large ways, like when USDC after Silicon Valley Bank. But look, even if the variations are only a penny or a fraction of a cent, if you think about very, very large transactions or transactions that are going to take place in the future, then if you don't know that the value is going to be at par, then these transactions become very complicated. And so you just want to avoid that complication. And so introducing a clearing system and guaranteed redemption solves that problem. Yeah. Sure.
So, first of all, I don't, maybe you have a comment on this, that is the development of several competing stablecoins desirable, or, is one, stablecoin or like an oligopoly of a few stablecoins still sort of okay? And to that extent, if we're trying to develop, a richer and more competitive market with all of these stablecoins, wouldn't singleness kind of pull that competition out? So, like, let's say I'm a small bank, I would probably just install the Circle stablecoin as an appliance in my bank, like a technological, device, right? I wouldn't go through all the trouble of developing my own stablecoin, but maybe contract with somebody to outsource the whole deal.
No, again, I mean, I think this is the whole point I'm trying to make is that we don't think of, I'm trying to get away from thinking of Circle as this particular form of private money that a commercial bank would adopt. No, stablecoins are simply clearing instruments. Every bank should issue one. Just as every bank allows their customers to write checks, instead of handing out paper checkbooks to their customers, they offer them these wallets whereby they can use stable coins. So this is something that every bank does. And again, we get away from, I was trying to make the point that we need to get away from thinking about this sort of market where we're sort of looking for dominant issuers. It just becomes, as Christian said, it becomes boring, right? The customer doesn't even really think about it anymore. But there's no reason in this world where this clearing system exists that every bank wouldn't provide this clearing instrument. And the fact that it's called a stable coin, well, that's just the way things have turned out, right? But it's just a digital form of checks. It's the next evolution of checks. And and there's every reason to believe that this could become a preferred payment instrument. The reason conventional checks died, as I said, and we introduced the ACH was in large part because banks, it became very cumbersome dealing with paper checks. Now we moved to digital imaging and all that sort of thing, but this is a new technology that could provide better payment services in some instances.
All right, I have the role of being the bad cop here, and suggested we defer any further discussion or questions to the breaks. And thank
Thank you.